You saw all the outflows from EM local debt. Where can you go that has risk that's insulated, you can take on risk that's insulated from the trade war?
Sure. So there are a lot of emerging market economies that are more domestic demand driven. And there have been some places where the election outcome has been actually quite positive for the reform momentum to continue and take place. A few places are Brazil and South Africa that quickly come to mind. Again, large economies, more driven by domestic demand, positive election outcomes, and the reform momentum continues there. The other place I would say is in the short term, any oil exporting nations such as the Gulf or even Russia, where the macroeconomic framework is very sound, or some countries in Africa also look quite good. I mean, they have to think of oil in the short term as manna from heaven and really build up their buffers because long-term story on oil still drives oil prices back to around 50 or so.
So if we talk about a large economy and an election, it makes you think about India.
Sure.
We're in the final stages of an ongoing election over there. What are the prospects for further reform there with Mr. Modi, or could it actually retrench given where he stands?
Yeah, no, that's a great question. I think our expectation is that although the Modi government comes back to power, it will be with a reduced majority, which would make it, from a checks and balances perspective, that's actually positive. But from a reform momentum, I think the Modi government did a lot of reforms earlier in the last election cycle. And so what we should see is this government looking to basically benefit from the reforms that were already put into place, but new reform momentum is unlikely to be there.
So, Ajay, from your point of view, where is it cheap enough? Where are valuations cheap enough in the equity market, or you also get less exposure to China trade?
Well, so they're two separate questions. I'm not so sure.
Fuse them together.
Yeah, so the cheap stuff is the usual. It's always Korea, it's always Russia, and they're cheap for a reason. But I'm not so sure I want to get away from the China trade war. I mean, I'm a little bit bored of this now, because either do a good deal or do a bad deal. I think the market will be happy with both outcomes. But stop talking so much and just get something done. Because I think this whole China trade war thing is a tempest in a teacup. And China is in other words, I just have never believed it mattered as much to either economy. It certainly matters a lot to confidence. So China is a $14 trillion US economy, exports about $500 billion to the US. The US exports about $400 billion to China, including domestic subsidiary sales. So these are very, very small numbers. And I think the stuff in a Nike shoe for $100 or $120, you'll still buy it. And so the price elasticity is very high. So to me, I think the Chinese should simply sign a bad deal.
Well, that's a good suggestion. It doesn't look like they're going to take that suggestion. So it's a bad news. It looks like you're going to have to be bored for a while longer. Assuming this doesn't get resolved in the next few months, okay? It goes on for a while, which seems like a reasonable prospect. What Anupam said is basically go defensive. Go to markets that basically are domestic. Is there an offensive play to make? And that's to say, for example, in Southeast Asia, as people redo their supply chains, might there be some upside in some emerging markets?
Yes. So the change in supply chains, the biggest beneficiary is going to be Taiwan and then Southeast Asia. Because you need the engineers, you need the manufacturing guys, you need the educated labor force. So Taiwan already is very good at this stuff. And we believe in something called modularization, which means different parts made in different parts of the world and then stuck together in the U.S. And so the U.S. might also be a beneficiary.
Oh, that's interesting. Interesting. So then stay over in Asia for a second, Anupam. So if you take a look at China, what do you do there? Because if there's going to be more stimulus, if growth slips, you're going to have domestic stimulation from the government, right? So how do you play something like that?
So unlike the equity markets, the EM debt indices are actually very diversified. So China and even Asia combined is only 17 or 18% of the index. So we can afford to, and a lot of the Asian names are very low yielding, so we can afford to be more aggressive in some other parts of the market. Having said that, like Ajay said, it's not like you have to be completely go defensive, right? Trade tensions are going to ebb and flow, but we have seen in the past just as the stresses or the downside from the tariffs become apparent, the idea that even you get back onto negotiations to sign a deal, even if it's a bad deal, or more policy stimulus from both the PBOC and possibly even the Fed as financial market conditions tighten, could very well create a risk rally in markets.
Ajay, one of the things we're hearing this morning from a number of analysts is that, in fact, if these trade talks go on the way they've been going on, we could see Chinese GDP growth dip below the 6% rate. Even with all the stimulus, people say it could dip below that. If that happens, are all bets off for EM? What does that do?
Yeah, if that happens, yes, of course. EM's Asian markets do not like Chinese nominal growth to go down at all. But I just completely disagree with that view. As Anupam said, I think the longer this goes on, the more aggressive the PBOC easing is going to be, and you'll have more fiscal stimulus. So I actually think that you'll actually get easier policy, which is actually going to be pretty good. We saw a bit of that in the first quarter, when you had a massive increase in credit. And so, watch out for that.